A refinance is a new first mortgage that will pay off your existing first mortgage. You'd want to refinance for a few different reasons: to lower your interest rate and your monthly payment, shorten the term of your present loan, or to take cash out for home improvement, debt consolidation, or college. The best time to refinance is when the current interest rates are lower than your present rate. You should also take a look at what term mortgage you have now. For instance, if you have a 30-year mortgage that you took out 5 years ago, you may want to refinance to a 25-year instead of a 30-year, so you can still pay it off in the same amount of time. You may also want to refinance if you need additional cash for home improvement, debt consolidation, or college tuition. In this case, it may not matter what the interest rates are because your need for cash supersedes your need for a lower payment. Qualifying for a refinance is similar to qualifying for a home purchase. We would need to look at your credit, income, and debts, as well as the equity that remains in your home. So not only do you have to qualify for the payment, but you also need sufficient equity in your home. Although it's difficult to determine what your home is worth without a property appraisal done by a professional appraiser, there are a few ways to get an idea of that value. You may have had a home or two sell in your neighborhood. If so, take a look at the style, size, and condition of those homes compared to yours. An appraiser is going to look for current similar sales within 1 mile of your home, and those neighbors' homes that just sold will give a good indication of that. There are also websites you can look at, but be careful to also check the similar sold homes if they have them available, because the site may only give you an average of all sales instead of only using the most recent closest similar sales. Once you have a reasonable idea of your home's value, we'll then be able to determine if you have enough equity to refinance. You want to have at least 20% so you won't have to pay for private mortgage insurance. You can learn more about PMI by checking out our video series on the website. It's at this time you should determine if you would like to take additional cash for home improvement or debt consolidation. You apply for a refinance the same way you would apply for a mortgage for a home purchase. We'll have to pull your credit report to get your credit score and determine the best interest rate available for your particular situation. You will have to sign disclosures that are pretty similar to the ones you signed when you purchased your home. Then we will order your property appraisal. The total process should take less than 30 days. If you have a home equity loan as well as a first mortgage, you may want to pay off both loans with your refinance. Chances are your interest rate may be a little higher if you were doing this. This would be considered a cash-out refinance. If you originally purchased your home with the 2 mortgages, then it would not be considered cash-out. If you don't want to pay off your home equity loan, you may be able to subordinate that loan to your new first mortgage. This means that the home equity loan will continue to be a second mortgage in second place to your new refinance mortgage. You would need to get permission from your present home equity lender to do this. The home equity loan must also meet the requirements of your new refinancing lender. There are similar closing costs for a refinance as there are for a home purchase. You still need to have an attorney for your closing, pay some lender fees, and start a new escrow account. You may include the closing costs in your loan amount when you refinance if you have sufficient equity. The rate you receive on a refinance is based on a number of factors: your credit score, the equity you have in the property, and whether or not you will be taking any cash out. The higher the credit score and the more equity you have in your home, the better the interest rate you will receive. You will most likely pay a higher interest rate if you take cash out as well.